Maverick Traders, this is Robb Reinhold. I cannot believe we are into December, one more month, and then we close the books on another year. And it's been a good year, it has been a great year in the markets, but it's been a very nice, good year. So let's jump into it. In this session, we're going to go over what happened last week. We're going to take a look at the news. We're going to break down all the markets. Then we're going to take a look at where the markets are right here, right now, with a fresh look. Did we get any technical scoring changes? We're going to look at all the sectors, and then we're going to look for potential setups this week in some of our favorite sectors, both longs and shorts.
Disclaimer. This video was created for professional stock and option traders. Maverick Trading is a proprietary trading firm that employs professional traders around the world. Our traders trade firm capital and keep 70 to 80% of profits they generate. All trades and analysis in this video are for professional traders only. If you are interested in becoming a professional trader for Maverick, click the apply button in the video description. Let's get ready for the week.
Last week was a good week. It wasn't a great week, but we had the fifth week in a row that the NASDAQ was up. And basically, we're just building on gains. We're going to take a look at a chart here in a second, and there is no pullbacks in this market. Now, I've been talking with traders. I talk with a lot of traders every week, and I've got a handful of people that are doubting this rally, and they say it's got to have a pullback. It's got to take a break. And I've been saying, no, it doesn't have to. When we see a market like this, it's telling you that people are on the bid. When we look at the chart, I'm going to explain to you what that means, but it's really all about this year-end performance chasing. We got some big news in economics. So we had the third quarter revised higher, and we also had a good print on the PCE price inflation report. Let's first off take a look at this preliminary GDP report. We got it on Wednesday. Now, this was the second report of third quarter GDP. The way GDP reports work is they have the first one that they rush out. 3 weeks after the quarter ends, they get what's called the initial. Then they get the actual, which is the second number, and then they get the final, which is the third number. That's the number that goes in the book. This was the second number. The first number was 4.9% GDP in the third quarter, and they raised it higher by 0.3%. 5.2, that number is super, super hot. That's a great economy. And then it came along with the Fed's favorite inflation reading, the core PCE price index. It came in as expected. This is the core, came in at 0.2, but the headline number came in at 0.0% when the expectations were up 0.1%. So we continue to see all of the inflation numbers just falling off altogether. This is saying that this economy is still doing okay. Not great, but okay, and there's no question in anyone's mind that the Fed is definitely on hold here. So before we jump into last week, let's take a look at some of the trades. Now, we took the week off for the holidays, so these are trades that were placed 2 weeks ago. And the first one I want to talk about is this sideways trade on BEKE. Now, we did a sideways trade with 16 as the midpoint. So 16, the closer we get to 16, the better it is. And we went from 15 to 16 up to 17. As you can see here, we got pretty darn close. I know I bought this butterfly for 29 cents and sold it for 75 cents. So that was a really nice return here on BEKE. Next one is General Electric, GE. 2 weeks ago, we did a diagonal call spread. Now, I am a huge fan of diagonal call spreads. If you're fairly new, get ready. You're going to hear about this over and over and over again. Diagonal call spreads are my favorite strategy. But I have to admit, the first time I learned these, I thought they were about the dumbest things ever. The risk graph didn't make any sense. If someone showed me, hey Rob, check out this risk graph. This is what it's going to look like. If it goes up, you make a tiny bit of money. If it goes down, you lose a whole lot of money. I'd say, yeah, no thanks. I'm not interested in that trade. I absolutely love these trades, and I credit these trades as the trades that got me out of my perma-bearness. I used to be a perma-bear. I was always doubting the markets, always doubting that it was going to be a bull market. always fighting bull markets, because I didn't want to be the idiot that bought at the top. My ego couldn't handle it. So I couldn't just go long, just wildly bullishly long, because my ego wouldn't allow it. So this is a chicken long. This is a really good chicken way to go long. And so when this thing ran up, we said, hey, you know what? It's either going to go up or stay where it is. And that's a great place to be in a diagonal call spread. But here's where I love them. After the position, the short leg expired. Remember, this is a long option that's dated further out. So I believe this one was a December 15th. And I went short the November 26th option. Once the November 26th option expired, I continued to hold the long call. Now I have changed my risk graph to look like this. Now I like that much better. So I got 1 week where I could be a chicken. And then as long as I liked it, I got to turn to a more aggressive strategy. And you can see it is breaking up higher, looking really, really nice. Did the exact same thing on KKR. KKR, diagonal call spread here. It expired, held on to the long calls, had some news this week. Boom, popped up. I took profits on this one for a really nice gain. And again, it started off as a very boring diagonal call spread. Once that short call fell off, it turned into a very exciting long call position with a lot of upside potential. For 1 week, I got to be a chicken, and then I got to reevaluate it on Friday. Now look, it doesn't always work out like this. I also did a diagonal call spread on VALE. So this was the day that it expired, came up, ran up a little bit, but came back down. I continued to hold the long call, and really this week, it looked like, this one's going to be a dud. Got a decent candle on Friday. We could still have some upside, but I'm running low on time. I only have 2 weeks left on this, and my rule is if I'm just in long calls, I have no ability to sit through a pullback. This thing either has to work on Monday or it's getting cut, and I will simply move that capital to another place. Let's take a look at the numbers on the market this last week. Now, first off, let's take a look at the Dow and just say whatever. Now, the reason I'm just not a big fan of the Dow, if you heard my end of day video on Thursday, I talked about how stupid of a index this is. It's only 30 stocks, and it's a price-weighted average. So the higher the price of the stock, the bigger of an effect it has. So Salesforce and Boeing, the two highest priced stocks in the index, had great weeks. The rest of them were flat. But now we've got this number that everyone's like, oh, Dow Jones stocks are amazing. No, just two of them. So what really happened was a pretty boring week. S&P up a little bit. Q's flat. The Russell is coming well off the bottom. The Russell was underperforming so bad last year, so it is getting a little bit. And really, I want to point out gold. What a week on gold, and really what a month on gold. The US dollar is cratering at the moment. We're going to take a look at bond yields. We're down to 4.2% on the 10-year bond yield. The lower that the dollar goes, the higher gold's going to go. I think gold looks really good here in the materials sector. So let's take a look at this chart. And I really want to point out what's happening here. When retail goes and buys stocks, they go out and they put in an order. They say, oh, I'm going to buy shares. I'm going to buy it at the market. And they buy 100 shares, 1,000 shares, 5,000 shares, whatever. When an institution comes in and buys, they're buying hundreds of thousands, if not tens of millions of shares. You don't just hit buy at the market when you're buying 10 million shares. You have to get in the right way. And the way you actually buy lots of shares is you buy shares when people are selling. It's much easier to get the fill you want at the price you want when there's lots of people selling. So what happens is these institutions, they sit on the bid. So we had our bottom in November. We ran up 8%. And look what happened. No pullback. Why were there no pullbacks? Because everyone was sitting on the bid, buying up the people that were taking profits. And then it ran again. And what happened? No pullbacks. Why? Because everyone's sitting on the bid. These institutions want to buy, but they're not going to chase it. As you can see here, they sat on the bid. We have a really long base here, and now we're breaking out to the upside. This is why I've been disagreeing with all the traders saying there's going to be a pullback. No, there's not. There's too much money sitting on the bid for any sort of meaningful pullback. So what we're going to see is basing runs higher. Basing runs higher. We're going to see what is called in the industry as a melt up. This is a melt up. It's not aggressive buying. It's just every day it's melting up. Now look, the NASDAQ outperformed. It's just taking a little bit longer break. But again, no pullback. Why is there no pullback? Everyone's out there sitting on the bid. They all want shares. Why do they want to be so bullish? A few reasons. This is one of them. Take a look at where we were just a couple months ago. 5% on the 10-year bond. Look at where we closed today. 4.19%. That is very supportive of stocks going higher. Very supportive. So we have a lot of things. We have these bond yields that are cratering. We have an economy that's at 5.2% growth. We have a Fed that has told us they're on hold. And we have money on the sideline that's looking at the end of the year saying, I better get in. If this market goes without me, I might look really stupid at my year-end performance evaluation. The higher the market goes, the more money it's going to force in. If the market pulls back, it's actually going to relieve pressure on people saying, I need to get in. They're going to say, see, okay, we don't need to get in now. We pulled back a couple percent. We're not going to look stupid because we didn't buy in December. If the market doesn't go down, those people are going to be forced. They're going to be forced to buy into the market, and that's literally called performance chasing. So look, I'm going to be very bold. I like to be bold as a trader. And look, I don't mind being wrong. I've been wrong hundreds of times, but I'm going to be bold here. Just straight up bullish. That's all I can say. But Rob, look, I don't care. We're just straight up bullish. This is a melt up. We're in the part of the year where this kind of stuff happens. We're getting everything. We're in the seasonality pattern. This is a pre-election year. Decembers are usually very strong in pre-election years. Like everything is coming together. Now look, I'm not wildly bullish like I was in 2016 in December. It was right when Trump won. Everyone knew there was a tax cut coming. And I remember thinking, no one's going to sell in December. Why would you sell in December when you could sell in January 1st or January 2nd, knowing that you're going to pay less taxes on gains that you sell January 2nd than you sold on December 27th? That month, the markets were up 8 to 10% just in the month of December. I don't think that's going to happen. I think we get 2 to 3 more percent, but I do think it's going to be a slow melt up higher. Let's take a look at the schedule this week. We need to look at one thing, and that is the Friday payrolls report. If this thing is super, super hot, it might actually get the Fed back off the fence saying, hey, we're worried again. If it comes in as expected, 190, that's a beautiful number. Everyone's going to love that. Still a good number, not too hot. People are really going to like that number. We'll see what happens. But again, everything where we are here for the next month, I don't see a lot of reasons to be bearish. Now look, I don't see a lot of reasons to be wildly bullish like I would in 2016. It's just going to probably melt up a few percent and be pretty mellow as far as volatility goes. I did talk to a couple traders that were saying, I want to get long the VIX. And I said, look, just wait till January. Just wait till January. It's a much better trade in January. But they're like, it's so low. Well, guess what? The VIX can stay low for a very long time. Let's get into our score. I cannot go to a +3 yet. And let me tell you why I can't go to a +3 yet. Take a look at this 50-period moving average. Okay, we are starting to get a turn. We're starting to get a turn. Is it turned yet? I think it's a little early. Once it turns, I'm going to go to a +3. But look, I'm at a 2.5. +2.5. We got a high base breakout happening on the chart. And for the week, I don't think it's going to be a crazy week. I don't see all these huge green candles. I see a week like we had this week, We're just every day it's up 0.2%, 0.3%, and by the end of the week it's up 1%. I don't see a lot of excitement, but what I don't see is a lot of selling. And again, that bid is very, very thick. Let's go ahead and take a look at all of our sectors one by one, and we'll score them. Remember, this is from 2 weeks ago. We're going to have a lot of changes.
Have you been trading in the markets for at least 2 years? Are you starting to see some decent progress? Is that progress so small because of your limited account size? Maverick Trading is a prop firm that provides capital to profitable traders. You trade a minimum $25,000 account and keep 70 to 80% of the profits. After 2 consecutive profitable months, you move to a $50,000 account. As you keep progressing, you will be able to trade 6- and 7-figure accounts. To learn more about trading for Maverick Trading, either click on the Apply card in the top left, click Apply at the end screen, or click the link in the description to watch our recruiting video that explains more about Maverick and prop trading. If you like what you see, apply for a position and meet with our recruiters. Are you our next trader?
Before we score them, let's take a look at the performance. Best performing sector was real estate. Lower interest rates, tremendously helpful to this sector. This is a pure interest rate move. Utilities, not doing as good, but look, still nice moves. Worst, communication services. Hey, this has been one of our best performing sectors. If you take a look at some of the big cap tech stocks, Meta, Google, they pulled back this week. And it definitely hurt the communication services sector. We'll take a look at the chart. Other than that, we saw these 2 sectors, financials, industrials, fantastic. Materials, beating the markets. Everything else was pretty much a market perform. Financials were my favorite sector 2 weeks ago. I've been loving the move in financials. It's been fantastic, but I'm looking to get more long in other sectors as both financials and industrials have had a nice run. So we'll take a look at all these and let's see where can we get a little bit more bullish outside of these sectors here. Utilities, look, it's a +2. We don't have that moving average, that 50-day moving average moving up, but look at this. I mean, just a beautiful high base pattern breaking out, likely going higher. The market's a +2, utilities is a +2, market perform. Here is communication services, and you see we had this pullback. We had a pullback. We are now at a 20-period moving average, so we've got to give this a +2. +2, that's where it is at the moment. If it bounces, I'll go back to a +3, but just not as excited on that sector as I used to be. Here is real estate. What a beautiful, beautiful high base breakout to the upside. This is a clear +3. We've got the hook, we got the turn, so +3 on real estate. This is moving on to healthcare. Now, where we were 2 weeks ago in healthcare, we were actually at a -1 or a -2. I can't remember which one, but we're somewhere back here. It's done a lot of work, made a high, pulled back, made a new swing high. We're at a +2. This is one of the sectors that I want to get more bullish. It was bad. It's now turning into one of the more bullish ones. I definitely want to get more exposure into healthcare. Industrials has been good, and boy, what a great high base breakout here. Just a solid high base breakout. What's there not to like about this? I mean, high base breakout, clear +3. This thing didn't even hold long enough to really even be called the base. I mean, look at these candles. They're all green. Every single one. I mean, well, I got to count these just to be curious here. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15. Now look, these are green candles. Not every day was an up day. Like this is probably a down day, but it was still a green candle, meaning it closed higher than it opened. The money is pouring into this sector. It loves the lower interest rates, but loves the stronger economy. +3, and this is, again, it's the strongest sector out there. I think you want to stay in this one, but if you're overweight like I am, I'm looking to go elsewhere. Just with new money. I'm holding all my positions. They're all looking great. Here is consumer, +2. Okay, it's decent. It looks like it's ready to break out of this little base here, so let's see if it can break out and we can get bullish in that sector. Tech looks great, but had a huge run. It was the outperformer at the start of this run. I'm going to again say the reason we get these chart patterns is because, yes, everyone's a little tired of the tech run. Tech's had a big run. But whenever it tries to pull back, the buyers are there. So it's going to base and likely break out higher, but +3 all the way. Look at materials. This is my favorite. I used to hate these. You know, when you're looking for a pullback and you get this rising base, a rising base to me was like, I wanted it to pull back here and now it's over here and I'm supposed to buy it? No way. If I couldn't buy it here, how could I possibly buy it here? I love rising bases because what do rising bases do? They go exponential. They go exponential, and here we go going exponential. It's a +3. Sorry, it's a +2. The reason I gave it a +2 is when they go exponential up, they typically do come back exponentially down. I'm more interested in being a buyer on the exponentially down. I think if you were already in it, enjoy the ride. It's likely to go further. But for me, I want to get a little bit of a break here on this hot price. And last but not least, well, actually, it is least. It is energy. Here we are. We're down here at the low. We cannot get out of this range. We just cannot. The market's super bullish, but the market's not all that bullish on energy. So if we rack them and stack them, this is where we were last week. We got a little bit of movement. Comm services weakened a bit. Materials, real estate, and industrial strengthened. Healthcare was the big jump. That's the one I'm the most interested in this week, is getting more long in healthcare. I was actually net short in healthcare until earlier this week. I now want to get net long in the healthcare sector. So let's go ahead and take a look at some potential trades in some of the favorite sectors, and we'll look at some option stuff. Many people are unfamiliar with exactly what proprietary trading is. Prop trading is when a private firm hires traders like you to trade with their capital. Those traders are paid a percentage of the profits that they generate for the firm. Profitable traders are awarded higher and higher levels of capital to trade so they can take bigger positions and make more money. We've been in business for over 25 years and we're one of the oldest prop firms based in the USA. If you would like to look into being a trader for Maverick, look in the video description below and click on the trader position to apply. Real estate, super hot at the moment, just on fire. Again, the interest rates are definitely going to help it. Here we have American Tower, AMT. So AMT, nice high base. We broke out of that on Tuesday, and now we're on a run here. So here's the question. How do you handle these stocks? Because when you take a look in this sector, there's not a lot of stocks in this sector that fit my criteria of over 2 million average daily volume and over $10. I think there is like 25 stocks. So then when I sort them for performance, there's really like 8 stocks that I really can take a look at. And this was my favorite one in the group. It just broke out of a high base, but it already has run 10%, well, 5% in a week. The most likely thing that happens is a base. That's the most likely thing that happens here. Now, I can wait. I could be patient, but we all know what happens a lot of times is these things just continue on without you and they don't base. People have been waiting for pullbacks and bases for 3 weeks and they're sitting on their hands. So how do you get into a position? Even though it's already run and you think it's probably done running, it's probably going to base. Well, you probably guessed it. My favorite strategy, the diagonal call spread. Diagonal call spread, here it is. So you're going to look to buy the 200 of January and sell the 210. Now that 210 is at the money. It's at the money. So this whole spread is going to cost you about $8.50, maybe even $8.80. What happens is that this thing just keeps running. It just keeps running. It keeps running. Your spread probably gets to like $10.50. So let's say you bought it for $8.80 and it just takes off and runs. Okay, you made, what is that, $1.30. So you basically made about 18% over 2 weeks. That was the return. Let's say it just hangs out here at 210. It hangs out here at 210. At the end of the week, it's probably, or sorry, at the end of December, options expiration, it's probably worth about 1050. You still made money. Again, the risk graph on the diagonal call spreads, and this one especially is going to be like this, where it just is very flat. So if it takes off, you make money. If it stays in this area, you make money. The only thing you don't want is a big pullback. If it has a big pullback, then yes, you're now start to lose money on your risk graph. But position sizing, you've got extra strategies, everything to protect yourself from that. This is a way to get long. Now, here's where I like the trade. So let's say that this trade hangs out at 210 for the next 2 weeks. And let's say 2 weeks from now, it's at 209.50 on the December of the short call. You let it expire, you now have a long call that's already have a profit built into it. Now you're going into the last 2 weeks of the year. The last week of the year is what's called Santa Claus Rally Week. The last 4 days of the year plus the first 3 days of the next year is the Santa Claus Rally. Those are typically very bullish weeks. You now get to go into those weeks with just a straight long call in a hot sector with a hot stock. Again, I love these diagonal call spreads. They don't look sexy at first. I get it. I agree with you. I fought this, but they look great. All right, let's take a look at Cardinal Health in the healthcare sector. This is the sector I want to get more bullish in. Same thing. We've got a nice stock making runs higher. It's likely going to have to sit and wait for a little bit. Okay, it can sit and wait for a little bit. I got no problem because I've got a strategy for that. Diagonal call spread. This one has weekly, so I can go on a 1 week basis. So I'm looking to go out either the 22nd or the 29th. 105, and I'll sell the 108. Look, I'm just selling the 108. That's hardly bullish at all. If it takes off and runs, I make a little bit of money. If it hangs out in this area, I'll be profitable. And if it tanks, yes, that's the problem with diagonal call spreads, but that's why we do these on very specific trades and very specific market conditions. If you want, you could just be in the bull call spread and be more directional as well. Lots of things you can do here with Cardinal Health. Industrials. Here we have a stock that is broken out. So this is different. Hopefully you can see the last two were entering bases. They were entering bases. This one has been in a base and has been in a base for a while. And now it just broke out on Friday. It's likely going to have another couple days of a run. So this is where I think you do a little bit different strategy. This is where I really like this bull call spread. The 92.50.95. It's going to cost you about $1.10, and you've got a $1.40 upside. And again, 95 is the max gain price. So if it goes past 95, hey, that's a max gain. We love those. We'll take those all day long. Moving into the materials sector, this is another sector, again, looks super, super hot here. The question is, how do you play these hot sectors? Like I said, this thing is going parabolic. We've got this Dow that didn't go parabolic. It based with the sector. The sector went parabolic on Tuesday. Look, this thing's starting to go here. It's just breaking out of its base. This is where I like the bull call spread much better. I like the bull call spread better because I think it's out of its base. I don't think it is basing. When it's basing, I like the diagonal call spread. Breaking out to the bull call, I like this one 52 up to 54. So 54 up here, that's going to be the profit area. If it goes up there, that's a max gain. We love that. Anything between is going to be a small gain. And anything below 52 is going to be a max loss. Pretty straightforward here on these vertical spreads. Again, as you can see here, breaking out on Friday after a 2-week base in a sector that's just super hot right now. Looks like a really nice trade. Now look, it was so easy to find bulls. So easy. Not so easy to find bears. Now people are going to ask, why are we looking for bears, Rob, in this strong market? Because we're wrong sometimes. And sometimes a really bullish market can turn really ugly really quick. And if you don't have bears, your account value is going to drop pretty quick and it's going to force you to scramble. We don't like our traders to have to scramble. So we hold longs and shorts all the time, fully knowing that in very strong market moves, our other side of the trade is going to drag on our performance. We get that. We know it. It's part of what we plan for. So energy is the sector. Here's ExxonMobil, and you can see here, it is not running. We have been in a low base for a long time. If we were in any other market condition, I would want to be very short in ExxonMobil. I would be looking at below 100 for a target, saying, okay, what trade can I make to profit the most on a move breaking down below 100? We are not in that market environment. We're not. So I'm looking at what I call a chicken bear. I just want a bear here. I don't really think this thing's going to fall, but I need to have some bears in case we do weaken. So I'm going to look for the weakest stuff here. I'm looking at, again, this is a chicken trade. 1 week, 102, 104. Bear call spread. I'm literally playing it from here to here. I know. Pretty bold, Rob. Pretty bold. That's a, like, again, can you see how chicken that is? That is the most chicken trade. If it's above that square, I may take a max loss. If it's below that square, I get a max gain. Anywhere else, it's small gain, small loss. This is right in the midpoint, which means it's a 50-50, 1-to-1 trade, meaning it's a coin toss. Now, again, it's a coin toss statistically, but I think with the chart and with the energy sector falling, I've got a little bit better odds. But these are the kind of bears I think you should be taking here when you do take your bears. We don't want to be aggressively bearish here, but we do need some bears because if we do get a pullback, if you're 100% long, the pullbacks really hurt and they cause you to have to scramble and dump good positions, or it causes you to get stuck in the headlights where you can't make any move, and then it turns into a bigger pullback where it turns into a 5-10% pullback, and now your account gets decimated. We want to make sure that that doesn't happen with our traders, which is why we always advocate having some shorts working, having some longs working, so if that happens, it doesn't put you under pressure. Wrapping this up, bullish market. Straight up bullish market. It's there. Again, you can see there is no pullbacks. The bid is a mile thick. People want to buy. They're just waiting for people to come in and sell so they can pick them up. Eventually, though, they're going to be forced to start buying on the ask. When they can't get enough shares filled on the bid, they got to go start hitting the ask, and that's when we see those green up days. Focus on the sector strength and weakness. That's always where you're going to want to be. Always carry some longs, always carry some shorts. Everyone have a great weekend. We got one more week left to add to our percent, and then we'll close the books and look to 2024. All right, goodbye, everyone. Have a good weekend.